Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're talking about what's going on with the newly public Peloton, and then we also take a look at WeWork and some other hot startup / newly public companies to get a sense of the broader 2019 IPO picture. But before we get into everything else, I want to remember if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. So on the show before, we've talked about Yeti, which is a company that went public in the fall of 2018. They recently opened a store in Chicago. We've done a Beyond Meat podcast. We've talked about Canada Goose. We've talked about Gatorade competitor Body Armor, which Coca-Cola took a massive stake in last summer. And I've actually done a couple months back a little bit of a preview of Peloton when they decided they were going to go public, and this is a tech-focused stationary bike company, for those of you who don't know. So they officially went public last week, and now I want to dive into everything that we know about Peloton so far, and then, as I mentioned, take a look at WeWork and some other of the newly public companies this year. So I want to do a little bit of the basics before we talk about Peloton's start on the public markets last week. So Peloton was founded in 2012, and as I said, it's basically a high-tech stationary bike with a TV monitor that gives people or users the ability to follow along with classes on a connected monitor. It's part of this larger kind of high-end workout class movement that's spread from New York and LA and Chicago to kind of all over the US and some international locations as well. But unlike physical locations, such places like SoulCycle, which can charge up to $35 a class to go take an hour cycling class, Peloton's pitch is that you're doing all of this in the comfort of your home. It's a New York-based firm that has showrooms around the country. Based on SEC filings, they have 74 showrooms to be precise. The company's core bike starts at $2,245, and they also offer a 0% APR financing plan for as low as $58 per month. So you can buy it for basically $2,245 or $58 a month. They're now also promoting directly on their website a 30-day home trial, just to maybe get more people interested. And then they also have kind of different levels of this, but it's all the same bike. And then they slowly try to upcharge you with shoes and weights and headphones and heart monitors. But that core bike is going to cost, as I said, $2,245. And that might sound a little crazy since you can get low-end stationary bikes for $250, but companies like Nordic Track and other well-known companies also sell similar stationary bikes for up more than $2,000. So they're not selling something that's totally out of the ballpark. This is not like it's 10 grand or anything completely crazy like that. And then on top of that, you pay for a Peloton membership, which is $39 a month, and then you get access to all of these classes, which are either live throughout the day at certain times or on demand through a library of different classes. And there's instructors, and they have actual instructors that are employed by Peloton, and there's some studios where you can really go to a Peloton studio. But the idea is to do this all at your house. They say they have 20 plus live classes a day and then thousands of on-demand classes. They also have classes for running and different boot camp style classes, yoga, outdoor. So it's not just the bike that they're offering through this membership. So they give you access to do other classes through an instructor through these on-demand videos as well. And then a possible bigger part of their business, perhaps going forward, they also sell just a digital membership. So you don't have to have a Peloton bike, but you can buy a digital membership and then use your own device or smartphone or monitor through their app. And this is $19.49 a month. So $20 a month to use, sort of a little bit pared down version of their Peloton membership. And then they also have a treadmill, which is a newer product. It came out in 2018, and they run similar classes on the treadmill as well. It's all kind of part of this bigger thing, from treadmill to cycling to boot camp and yoga. And these are actually much more expensive than the bikes. These start at $4,300 and run as much as $4,844 with those similar extras in there as well. And as I mentioned, SoulCycle, just to give people a sense, this is kind of who they're competing against. It's the biggest, you could say, more well-known company that's on par with Barry's Boot Camp and these other high-end, expensive gyms. SoulCycle starter classes. So for 5 classes, if you're your first time going, you can get 5 classes for $100, and then you can get 10 classes for $280, and you save $40 basically. And then one SoulCycle class costs, I was a little bit wrong at the beginning, one SoulCycle class costs $32, and then 5 classes when you're not a first-time member cost $148 for 5 classes. So Peloton is charging you basically $40 a month for unlimited classes. You could do 50 classes a day. I'm totally making that number up, but you could be on your bike doing these live or on-demand classes all the time, whereas SoulCycle, it's $32 a class, and you have to go to one of their locations. So that's Peloton's pitch. Do it in your house, do it in your garage, do it wherever you want, and you don't have to go to the studio and spend all of this money. Obviously, you have that upfront cost of the bike, but with their digital membership, you don't even have to have their more expensive bikes, you could say. And now I want to dive into some of the numbers from their recent SEC filing, just to give people a sense of how big the company is and how much money they've made / how much money they've lost so far and within the last couple of years. So Peloton says that its loyal community of over 1.4 million members. They define a member as, quote, any individual who has a Peloton account. And this is as of the end of fiscal 2019, which ended at the end of June. And then they have, and this is all their numbers. So in 2019, their connected fitness subscribers were 511,000 with a churn rate of 0.65%. So not losing a bunch of members, which is a good thing. And then they say their highly compelling offerings, and this is directly from the SEC filing, that their members have completed over 58 million workouts in 2019. In 92% of their interactive fitness equipment ever sold, which they refer to as connected fitness products, still had an active connected fitness subscriber attached. So once you buy, most people are still subscribing to these monthly memberships, which is a good sign for their business model long term. And then as of June 30th, they had sold approximately 577,000 connected fitness products. And most of those, pretty much all of those, are coming from the United States. And then terms of revenue, they produced their revenue over the last 3 years. So in 2017, they made roughly $220 million. They jumped then 99% to $435 million in 2018. And then they jumped another 110% to $915 million in 2019. So we could see them easily hitting that $1 billion threshold in 2020. But we do not actually, on Zacks.com, have any estimates yet. They just went public last Thursday, so those should be getting to our system relatively soon. But for all this revenue growth, the company is also still losing a lot of money, which some people might expect for a young, still kind of startup vibe company. So they lost $71 million in 2017, and then they lost less money actually in 2018, which is a good sign. They lost just $47 million in 2018, but then that loss really, it almost more than quadrupled in 2019. So they lost $195.6 million in 2019, and that was on revenues of $915 million. So they made a lot more money last year, but they also lost a lot more money overall. So not the best sign for Peloton, but companies go public all the time, still not making a lot of money. Amazon wasn't making money for years and years. This is nothing crazy out of the norm. So anything could happen with the company going forward. It's good to see that revenue growth is still there. And their CEO, John Foley, told CNBC last week, right after they went public, that he expects the company to be profitable by their fiscal year 2023. So within the next 4 years, he's expecting Peloton to be a profitable company. In their current markets, as I mentioned, most of their business is pretty much in the United States. They also have business in the UK, Canada, and Germany, and most likely looking to expand beyond those couple markets as well within the next few years. And then this is also from their SEC filing. They're talking about their total addressable market and then their serviceable addressable market. So right now they see their TAM, which is, as I said, their total addressable market, as 67 million households, of which 45 million of those are in the United States. And this is based on their research of people who are actively in this broader workout, cycling, treadmill world of anyone looking into that. And then they see their serviceable addressable market as 14 million of that 52, with 12 million of that coming from the United States. So they see the ability to clearly grow to be much bigger than they are at the moment. And now I want to touch a little bit on the IPO last week, and then we're going to dive into some broader IPO and startup news before we round out the show today. As I mentioned, Peloton went public last Thursday, September 26th. It's trading under the ticker PTON. And they priced their IPO at $29, and the IPO was underwritten by Goldman Sachs and JP Morgan, or they were the lead underwriters. And the stock opened last Thursday at just over $27 per share, so it was underneath that IPO price, which is never a great sign for a public company. But as I said, who knows where the stock's going to go going forward. They sold over 40 million Class A shares, and this gives the company a current market cap of, this is as of Monday morning, at around $6.99 billion, call it $7 billion. And it was, once again, as a private company, it was quote unquote a unicorn, which is a company that's privately held that's valued at over $1 billion. And then as of Monday morning, their shares opened at $25 per share, around $25 per share on Monday. So down about $4 from that IPO price. And as I mentioned, we don't have any estimates yet for Peloton, so I don't want to speculate on what their revenue or their losses are going to be going forward. But we saw that top line growth has been pretty impressive over the last couple of years. So we'll update you when we have more on that. And now I want to get into some more IPO news. Anyone who's been following recently probably has heard that WeWork has been in the news for pretty much all of September, and their co-founder, Adam Neumann, resigned as CEO under pressure amid all of this valuation and strangeness that's going on with the company. So the company, once again, has done kind of what a lot of companies have done. They say they're a tech company, but really they're just an office leasing real estate company. And it's been around for almost a decade, and he stepped down basically over his management in concerns that the company is losing way, way too much money, and this derailed a plan to go public recently. So what made a lot of headlines over the last month was that its last fundraising rounds in the private markets gave it an implied valuation of about $47 billion. And then leading up to that, the company itself slashed its desired IPO valuation to about $20 billion. And then it was still even lower to almost between that $15 to $10 billion valuation. So from almost 40 or almost 50, so at 47 billion to around 15 to 10, which gets into a broader concern of what's going on with these venture capital companies that are pouring all this money into these startups with these sky high hopes, and it seemingly have at least recently a history of really overvaluing these companies. And then officially Monday morning, this was as I was pulling the rest of some last minute stuff together to do this episode today, after the CEO stepped down last week, they officially are withdrawing their initial public offering with the SEC. The company said it is postponing its IPO to focus on its core business and that it has every intention to operate WeWork as a public company, but did not provide any time frame for that going forward. So over the last month, things have clearly changed pretty dramatically for WeWork, and this tells a bigger story of, as I said, valuations getting kind of stretched in this easy money, low interest rate era. SoftBank invested billions of dollars into WeWork, and now they're probably wishing maybe they hadn't. And anyone who's dug into WeWork or seen any of the now former CEO's interviews know that he kind of played that rock star, I'm the total eccentric genius running this company. That's even stories you read. That's part of the reason why SoftBank invested billions of dollars into the company. And so I want to now dive into some data that I took from a Wall Street Journal article that I found very just kind of instructive to what's going on at the moment with some of these pretty bloated valuations, it seems like, for IPO companies that are trying to go public. So according to PitchBook data, 66 companies valued at $1 billion or more have done initial public offerings from 2011 through mid-September 2019. A third of those IPOs then came at prices below the value set in the company's last round of private funding. So a third of those companies are then when the average or the big, broader pool of people who have the ability to invest say, we don't think that this company is worth what you say it is in the private market. So that tells the story kind of on its own. And then some of these stats are from a larger, this same story that's called, quote, the story is titled "How We Should Bust an Investing Myth. WeWork's Postponed IPO Shows How Hollow the Narrative About the Superiority of Private Markets Can Be." So these are some stats that they pulled for some surveys from some venture fund executives. So when asked whether they, quote, often make a gut decision to invest in a fledgling company rather than relying on analysis, 44% of venture fund executives said yes. And then which financial metrics do they use to analyze investments? The question is none. Admitted 9% of respondents, and only 11% said they quantitatively analyzed past investment performance. So very interesting stuff there, to say the least, that very interesting stuff, to say the least, that people who are investing billions of dollars in these companies in the private market, 44% of them are saying they're kind of just relying on a gut decision, which kind of makes maybe the average investor feel a little bit better about themselves, that these people are investing hundreds of millions of dollars in a company, and half of them are saying, a little bit less than half are saying they're kind of just going on their gut without even necessarily looking into where the company's financials are at the moment and where they think they're going to be down the line. So not too long ago, people might remember that Travis Kalanick was forced to step down as the Uber CEO before they went public amid all of that stuff. Just last week, Juul's CEO, Kevin Burns, stepped down amid all of the vaping worries. This is with teens vaping, and there's now cases of people getting sick and in the hospital with this vaping craze. So we'll really see what goes on there. Juul was a story of, we're shaking up this industry, blah, 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 blah. Philip Morris owner Ultra invested $13 billion to purchase the 35% stake in Juul Labs. They might now be kicking themselves for having done that. So we'll see what happens with that. And now I want to just close with a bigger look at some of the bigger names who have gone public in 2019 and where their stocks have gone since going public. So we're going to look at Uber, Lyft, Pinterest, Slack, Smile Direct, and Beyond Meat, who have all gone public in 2019. So out of all those companies that I mentioned, this is Uber, Lyft, Pinterest, Slack, Smile Direct. So for those of you who don't know, Smile Direct is an Invisalign kind of company. They offer you braces. They offer you what they say braces will do without having to actually go into a dentist, blah, blah, blah. So basically Invisalign. Slack, for those of you who don't know, is a office communication platform that's trying to compete on a broader scale against massive companies like Google and Microsoft. So we'll see how that works for them. And then Uber and Lyft are those ride-hailing companies who most of us know. And then Beyond Meat is that plant-based burger company, just for reference. So out of all those companies, Beyond Meat and Pinterest are the only ones that are actually in the green after going public. Beyond Meat is up huge, up well over 120% from their opening morning price. And they really got off to a really hot start, and they've pretty much moved sideways for much of the last month or so. So coming back down to earth there. But then Pinterest is also up around 3.5% since it went public. And that's a social media-ish company that's proven it can make money, and it's very powerful with advertisers. And then Smile Direct is down over 20% since it went public recently. Uber's down 27%. Slack, which trades under the ticker WORK, is down 37% since going public, and Lyft is down 41% since going public earlier this year. So out of all these big, much hyped unicorns and tech companies that were going public this year, Beyond Meat was probably one that people didn't think would be on this sky-high run, and it's the only one that's really proven to be a great investment so far. But it's still early days, and you never know what's going to happen going forward. But Peloton's definitely a company to watch out for. And then, obviously, WeWork still has plans to go public later this year, but they've officially shelved those plans for now. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.